Hi professionals, this is CA Rohanar Pingal. Welcome to Tax Guru YouTube channel. Let me introduce myself. My name is CA Rohanar Pingal, practicing chartered accountant based in Mumbai and also partner in Motilal and Associates LLP, member firm of Mars Network. In last month, I had started two YouTube video series on Tax Guru YouTube channel, and that is on what law says. Case laws based video series, one on income tax and another on GST. So today, this is part two on case laws related to income tax and reported to ITAT and High Court. So let's dive into it. Let me allow to share my screen. Yes. What law says? Direct tax, part 2. First case reported to ITT. We will discuss first cases reported to ITT, and then in second part, we will discuss cases reported to High Court. Let's start. Additional CIT versus Ramchand Thakurdas Jamtani ITA number 3551 Mumbai 2024 assessment year 2017-18 date of order 20th February 2028 February 2025 relevant sections are sections 148 148A and 151. Let's understand facts and issue of the case. A notice under section 148 of the Act, old regime, was issued to the assessee. Subsequently, in compliance with the judgment of the apex court, communication was sent to the assessee, intimating that the aforesaid notice issued under section 148 of the Act would be treated as the show cause notice issued in terms of section 148A Clause B of that under new regime. The AO also shared material information with the assessee on the basis of which he had formed a belief that income escape assessment. First, we will see that notice under section 148 of that old regime was issued to the assessee. Then assessing officer also issued material in what basis he had formed a belief that income escape assessment. Thereafter, order under section 148A clause B of the Act was passed after taking the approval of the Principal Commissioner of Income Tax. This was followed by issuance of notice under section 148. The appeal preferred by the assessee against the aforesaid assessment order was allowed by the CIT appeals. Agreed, the revenue preferred appeal before tribunal while assessee filed cross objection. Let's see what tribunal observed and held at. Grant of sanction by the appropriate authority. Here, issue was related to sanctioning authority. Grant of sanction by the appropriate authority is a precondition for the assessing officer to assume jurisdiction under section 148 to issue a reassessment notice. The aforesaid order was passed after taking approval from ECIT. Since the aforesaid order was passed after expiry of 3 years from the end of the relevant assessment year, as per new regime, the authority specified under section 151 clause 2 of the Act, that is PCCIT or CCIT was required to grant approval. Non-compliance by the AO, the provision of Section 148A Clause D, read with Section 151 Clause 2 of the new regime affects the jurisdiction of the AO to issue a notice under Section 148 of the Act. Accordingly, the order on sequential reassessment proceedings and the order were quashed as being bad in law, as being violative of the provision contained in Section 148A Clause D, Section 148 and Section 151 Clause 2 of the Act. Tribunal allowed the cross objection filed by the assessee. Means, in this case, sanctioning authority was PCCIT or CCIT, but the order was actually passed after taking the approval from PCIT, and therefore the appeal was the appeal was allowed in the favor of the assessee. Sanctioning authority should be checked whenever we received any notice. That is the importance of this case law. Next, additional CIT versus Ramchandra Thakur's same assessee, but the assessment here is different and the case is also different for the same assessee. That is the ITA number 3552, Mumbai, 2024, assessment year 2015-16, date of order 20th February 2025, relevant section, section 149. Let's understand facts and issue of the case. For assessment year 2015-16, notice under section 148 of the Act was issued to the assessee. It was issued after the expiry of 4 years, but before the expiry of 6 years from the end of relevant assessment year. It was issued after the expiry of 4 years, but before the expiry of 6 years from the end of relevant assessment. The reassessment proceedings culminated into passing of the assessment order passed under section 147, read with section 144B of the Act. Aggrieved assessee preferred an appeal to CIT appeals, who allowed the appeal. Aggrieved, the revenue preferred the appeal before the tribunal, while the assessee filed cross objection challenging the validity of the reassessment proceedings. Let's see what tribunal observed and held at. A notice could be issued under section 148 of the new regime for assessment year 21-22 and assessment years prior thereto only if the time limit for issuance of such notice continued to exist under section 149 subsection 1 clause B of the old regime. In view of the first proviso to section 149 subsection 1 clause B of the Act, a notice under section 148 of the Act, new regime, cannot be issued if the period of 6 years from the end of issuance of the notice. This also ensures that new time limit of 10 years prescribed under section 149 subsection 1 clause B of the Act, new regime, applies prospectively and not retrospectively. The said proviso limits the retrospective operation of section 149 subsection 1 clause B to protect the interest of the assessee. Therefore, the time limit of 6 years in present case from the end of assessment year 15-16 expired on 31st March 2022. Therefore, notice dated 27th July 2022 issued under section 148 of the Act was barred by limitation. In view of the above, the tribunal quashed the notice dated 27th July 2022 issued under section 148 and the consequent assessment order passed under section 147 read with section 144B is being bad in law. Cross objection raised by SAC was allowed. Very important case. Next, APJ Abdul Kalam Education and Welfare Trust versus CIT exam ITA number 567 Jaipur 2024. Date of order 15th January 2025. Relevant section 12AB. Let's understand facts and issue of the case. The assessee was running a hostel. It obtained provisional registration. Thereafter, it applied for final registration. CIT exempt rejected the application for final registration and cancelled the provisional registration on various grounds. One of the grounds was non-registration under the Rajasthan Public Trust Act 1959, that is RPT Act, was in violation of section 12AB, subsection 1, clause B, subclause 2B. Aggrieved with the order of CIT exam, the assessee filed an appeal before ITA. Let's see what tribunal observed and held that. A plain reading of section 12AB, subsection 1, clause B, subclause 2B shows that compliance of requirement of any other law, compliance of requirement of any other law is required if compliance under such other law is material for achieving its objects, otherwise not. There is no section in the RPT Act 1959 which prohibits a trust to carry out its objects if it is not registered under the RPT Act 1959. Both the statutes, namely Income Tax Act and RPT Act, have their own provisions and implications, and none of them have overriding effect. Absence of registration under RPT Act 1959 cannot be a ground to deny registration under section 12AB. And accordingly, tribunal directed the CIT exam not to deny registration on this ground. Next, DCIT versus Chakradhar Contractors and Engineers Private Limited, ITA number 1939 and 1940, Punjab 2024, assessment year 2020-21 and 21-22, date of order 26th December 2024, relevant sections, section 270A, subsection 2, section 270A, subsection 9. Let's understand facts and issue of the case. The assessee was a company engaged in business of construction. Declare total income in return of income by estimating the income from contract work at 7.37% of the turnover. The assessing officer completed the scrutiny assessment. Assessing officer estimated the income from the contract work at 10% of the turnover. Means assessee estimated at 7.37%, whereas assessing officer estimated at 10% of the turnover. Assessee accepted and paid the due taxes thereon. Subsequently, the assessing officer initiated penalty proceeding under section 270A, referring to section 270A, subsection 9. He levied penalty at the rate of 200% of the tax payable on the underreported income in consequence of misreporting. On appeal to CIT appeals cancel the penalty on the ground that the assessing officer had not specified the sublink under section 270A, subsection 9, clause A to clause G, and therefore penalty was not sustainable. Aggrieved, the tax department filed appeal before ITAT. Let's see what tribunal observed and held. Where the assessing officer had not specified either in the assessment order or in the notice under section 274, read with section 270A as to under which limb of provisions of section 270A subsection 2 or section 270A subsection 9 the case of the assessee falls, no penalty under section 270A was leviable. The profit of the assessee had also been estimated by resorting to the provisions of section 145 subsection 3. No penalty under section 270A was leviable. And accordingly, the appeals of the tax department were dismissed. Next, Sai Baba Sansthan Trust versus DCIT ITA numbers 932 and 935, Mumbai, 2023, assessment year 2013-14, date of order 17th January 2025, relevant section, section 115 BBC and section 147. Let's understand facts and issue of the case. The assessee was a charitable organization registered under section 12A, section 80G and section 1023C, clause B. It was having a temple complex in the town of Shirdi. The assessee usually receives huge amount of cash donation by way of hundi collections, charity box collections from the followers or devotees of Sri Sai Baba. The names and address of the contributor is not maintained. The assessee filed its return of income declaring nil income, which was processed under section 143 subsection 1. Taking note of the annual information report, that is AIR, the AO sought to reopen the assessee's assessment by issuing notice under section 148. On the basis that cash deposits received by the assessee were taxable as anonymous donations under section 115 BBC. The writ petition filed by the assessee against the notice was rejected by the High Court. The writ petition filed by the assessee against the notice was rejected by the High Court. SLP against the said High Court judgment was also rejected by the Supreme Court. Accordingly, the AO proceeded to pass the reassessment order, bringing the anonymous donations to tax at the rate of 30% under section 115 BBC. On appeal, CIT appeals held that the reopening of the assessment was valid. Aggrieved assessee filed appeal before the tribunal. Very important case. Let's see what tribunal observed and held that. At the time of recording of reasons for reopening, the AO should have been aware. At the time of recording of reasons of reopening, the AO should have been aware of the approval granted to the assessee under section 1023 CV, which is granted to a trust existing wholly for public religious purpose or wholly for public religious and charitable purpose. Income Tax Authority were granted the approval both under section 80G and 1023C clause V to the assessee. Same was covered by the exception listed in section 115 BBC subsection 2. The AO had relied upon the approval granted under section 80G only and has chosen a document which would suit his requirement and ignored another important document which went in favor of the assessee, which is not permitted in law. The belief entertainment by the AO without considering the record in totality could not be considered as a legally valid belief under section 147. Very important. The belief entertainment by the AO without considering the record in totality could not be considered as a legally valid belief under section 147, and accordingly the reopening of assessment was not valid. Let's move on to the second part of today's video, that is cases reported to High Court. First case, Principal CIT versus Hespera Realty Private Limited 2025 472 ITR 630 Delhi High Court. Relevant assessment year 2015-16 and date of order 24th December 2024. Relevant sections section 1038. Let's understand issue of the case. Five companies which held shares of the entity IBHFL merged with ACC, and three of these companies sold their shares. Since the said amalgamating companies were merged with the ACC, the income earned from the transactions of sale at IBHFL shares were assessed in the hand, say, hand of ACC. The AO was of the view that the amount of LTCG was not entitled to exemption under section 1038. Commissioner appeals and tribunal decision was in favor of the assessee and rejected the appeal of the department. Aggrieved, department filed an appeal to the Honorable High Court. Let's see what Delhi High Court observed and held. There was no fault with the decision of the Commissioner Appeals and the Tribunal in holding that the entire amount of LTCG was not liable to be included as income chargeable to tax under section 1038. Therefore, LTCG from sale of shares of amalgamating companies with the SEC is exempt under section 1038. Next, Chamber of Tax Consultant and ORS versus DGIT Systems 2025 473 ITR 85 Bombay High Court. Relevant assessment year 24-25, date of order 24th January 2025, and relevant sections are sections 87A, section 139, section 143, subsection 1, and section 143, subsection 3. Let's understand issue of the case. The department releases utility for filing of income tax returns online available. This is very important case laws related to the utility releases by income tax. The department releases utility for income tax filing income tax returns. They releases every year. The department published a change in utility. Now, the department published change in utility. Said change unilaterally disabled the SEC from claiming rebate under section 87A. As a result, taxpayers, despite being statutorily eligible, were effectively deprived of their entitlements. The Chamber of Tax Consultants filed a petition seeking direction to modify the system. Let's see what Bombay High Court observed and did. The department could not restrain or prohibit an assessee from claiming Section 87A rebate by modifying their utility, by which an assessee was forbidden at the threshold itself from making such a claim in the return of income. Means what? Department could not restrain or prohibit to us, that is assessee, to claim any benefit under the Income Tax Act, that is like 87 rebate, by modifying their utility. They can't. Assuming that the legal provisions were ambiguous, the department can't resolve such ambiguity by adopting an interpretation favoring itself through the device of simply tweaking the utility and preventing the assessee from even raising a claim. The provisions of the Income Tax Act do not permit the department to do this without transgressing the constitutional boundaries. One of the foundations of our constitution is the rule of law. This posits that all three organs of governance, legislature, and the executive and the judiciary function under and in accordance with the law as enshrined in our Constitution. A combined reading of Section 87 and 87A would mean an assessee has to make a claim, the entitlement of which is to be examined by processing the return under Section 143 subsection 1 or under Section 143 subsection 3, and the same should be allowed as deduction. The department was directed to modify the utilities for filing return of income under Section 139 of the Act immediately, thereby allowing the assessee to make a claim of rebate under Section 87 of the Act, read with proviso to Section 87A. Next, Hansa Metallics Limited versus Deputy CIT 2025 472 ITR 737 Punjab and Haryana High Court. Relevant assessment year 2012-13. Date of order 22nd January 2024. Relevant section 276C. Let's see issue of the case. Whether delay in payment of tax, does amount to evasion of tax, and whether prosecution valid or not. Very important. Whether delay in payment of tax does amount to evasion of tax, and whether prosecution valid or not. Let's see what Punjab and Haryana High Court observed and held. Prosecution under Section 276C, subsection 2 of the Income Tax Act, read with other provisions of the Act, can only be launched if there was a willful evasion or attempt at evasion of either tax, penalty, or interest. Willful evasion is important, or attempt at evasion of either. Delay in payment of income tax will not amount to evasion of tax. Yes, very important. Delay in payment of tax will not amount to evasion of tax. Therefore, by no stretch of imagination will it be held that there was an evasion of tax on the part of the assessee, though there was a delay in the payment of the tax for which interest was paid. The prosecution was not valid. Next, Principal CIT versus Vikram Dhirani 2025 472 ITR 342 Delhi High Court. Relevant assessment year 2007-2008. Date of order 28th August 2024. Relevant sections 132 and section 153A. Let's understand issue of the case. Whether revenue is correct in making additions to income, based on data appearing in pen drive, not unearthed during search, and which doesn't constitute incrementing material. Whether revenue is correct in making additions to income based on data in pen drive not unearthed during the search, and which doesn't constitute incrementing material. Let's see what Delhi High Court observed and held. The pen drive and the data appearing thereon having not been unearthed in the course of the search under section 132 of the Act, it will not constitute incrementing material. It should be unearthed, means it should be found in the course of search under section 132. Otherwise, it is not at all be counted, will not constitute an incrementing material. The assessment was confined to section 153A, and consequently the signature of the incrementing material found in the course of search alone will be the basis for any additions to the. Since the pen drive was an article which was not recovered in the course of the search, but constituted material which had been obtained by the department through the exchange of information group. Here, the pen drive obtained by the department through the exchange of information route and not recovered in the course of the search. Very important. Therefore, additions to income can't be made on data appearing in pen drive, not unearthed during search, which doesn't constitute incrementing material. Thank you so much for patient hearing. Please note down my contact numbers. We will meet soon in the next part and hope you will like this video. If you really like this video, share with our professional network so it can reach to mass. And please subscribe to Tax Guru YouTube channel if you are not yet subscribed, so that you will be keep updated on various subjects and various issues on day-to-day basis. Let's meet in next video. See you soon.